Welcome to The Explainer. Let's be honest, if you've been wondering how to protect and actually grow your cash right now, you are in exactly the right place. Today, we're jumping straight into a highly actionable guide to beating the 2026 cash dilemma. We're going to look at exactly how to secure safe haven yields, and we're going to do it without taking on a single ounce of stock market risk.
Okay, let's dive into this. Here's our agenda for today. Section 1, the 2026 cash dilemma. Section 2, high-yield savings accounts. Section 3, Treasury marketable securities. Section 4, Series I savings bonds. And finally, Section 5, your ideal cash strategy.
So let me ask you right off the bat, where is your cash currently sitting? Take a second and actually picture your current bank account balance in your head. Because if you're keeping a large chunk of your savings in a standard, everyday checking or savings account, we have a very real problem. Inflation is quietly, invisibly eating away at that idle money every single day.
To illustrate just how much money you might literally be leaving on the table right now, consider this. Traditional big banks are currently offering an absolutely abysmal 0.01% annual percentage yield. Even the current national average is sitting at just around 0.61%. But the safe haven vehicles we're exploring today, they are offering yields hovering around 4% or higher, going all the way up to 4.26%. That is a massive difference in earning power.
Section 1, the 2026 cash dilemma. Liquidity versus horizon.
Moving right along to Section 2, high-yield savings accounts, which we'll call Layer 1 for your immediate cash.
Now, what's really interesting here is the sheer accessibility of these rates for your immediate reserve cash. As of May 2026, top FDIC or NCUA insured accounts are extremely competitive. CIT Bank is giving you 4.10% if you can swing a $5,000 minimum deposit. VioBank offers 4.03% with just a $100 minimum, and Lending Club sits right at 4.00% with absolutely no minimum deposit at all. Plus, every single one of these charges zero monthly maintenance fees, which is exactly what we want.
The pros here are fantastic. These accounts are incredibly accessible and federally insured up to $250,000. But, there are a few cons to keep in mind. The interest rates are completely variable based on Federal Reserve rates, meaning the bank can just change them at any time. Also, the interest you earn is fully subject to both state and federal income taxes.
All right, stepping up to Section 3, Treasury marketable securities, which acts as Layer 2 for slightly more structured yield. I know buying treasuries sounds super complicated, but there are basically just two main ways to do it. A non-competitive bid on Treasury Direct simply means you agree to accept whatever discount rate is determined at the upcoming auction, and you are 100% guaranteed to get the security. On the flip side, a competitive bid is done through a broker or a bank where you specify the exact rate you'll accept. But if the auction rate comes in lower, you might get nothing. For most everyday savers like us, non-competitive is absolutely the way to go.
And if you do choose that non-competitive route, the process is surprisingly straightforward. You just log into your Treasury Direct account, click the Buy Direct tab, and choose your security and the amount. What's highly appealing here is the accessibility. Treasury marketable securities require a minimum bid of just $100. There are a few quirky rules to know, though. Each security has a unique HYSA identification number, and new securities on Treasury Direct have a strict 45-day holding period before they can be transferred anywhere else. Also, sometimes the Treasury does these things called reopenings, where they sell more of a previously issued security. In that case, you might actually have to pay some accrued interest up front as part of your purchase price, but don't worry, you get that back later in your first regular interest payment.
Let's move to Section 4, Series I savings bonds. This is Layer 3. Your strategic reserve.
So the crucial point for this strategic reserve is an impressive composite rate of 4.26%. As of the May 2026 reset, this makes Series I bonds a remarkably powerful long-term inflation hedge. But how exactly do they arrive at that specific number? Well, the 4.26% composite rate is actually made of two parts. First, you have a 0.90% fixed rate. What's truly fascinating here is that this fixed rate is locked in for the bond's entire 30-year life. Second, there's a variable inflation rate, currently at 3.34% annualized, that resets every 6 months based on the Consumer Price Index. Having a meaningful fixed component ensures your money will genuinely outpace inflation. But there's a strict catch to keep in mind. You can only buy $10,000 in electronic I-bonds per calendar year per Social Security number. You absolutely cannot just park $100,000 into these at once. However, if you're a small business owner or you have a family, there are totally legitimate ways to expand those limits. You can open entity accounts for LLCs, S-corps, or revocable living trusts that have their own employer identification number, because each entity gets its own $10,000 limit. Families can also use the Treasury Direct gift box strategy. It's this neat trick where you buy an unlimited amount of gifts for a spouse now to lock in today's rate, and then you just deliver them up to the $10,000 limit in future calendar years.
Okay, we really need to talk about the holding rules because they are strict. For the first 12 months, your money is completely locked. You cannot touch it. From year 1 to 5, you can redeem them, but you'll face a penalty of losing the last 3 months of interest. After 5 years, they are entirely penalty-free. And finally, at 30 years, they mature and stop earning altogether, so you'll definitely want to cash them out then.
Now, the tax perks on these are seriously underestimated. While they are fully subject to federal income tax, they are completely exempt from state and local taxes. If you happen to live in a high-tax state like California or New York, that makes the 4.26% yield incredibly valuable. Plus, the tax is deferred until you actually redeem the bond. And if you use them for qualified higher education, you might even exclude them from federal taxes entirely using IRS Form 8815.
Let's move on and see how this all builds together in Section 5, your ideal cash strategy, the layer cake approach.
This is what we call the layer cake approach, which is a really brilliant concept sourced from Bean Count. Here is exactly how you map it out. Layer 1 is your operating cash. This is money you need in the next 0 to 90 days. Keep this simple, right in a basic checking or sweep account. Layer 2 is your reserve cash for 3 to 12 months out. This is exactly where your high-yield savings accounts or ladder Treasury bills shine. Finally, Layer 3 is your strategic reserve, money you know for sure you won't touch for at least a year. That is exactly where Series I bonds belong.
To actually put this into practice right now, run through this simple decision framework. Do you have 3 months of operating cash readily accessible? Will you genuinely not need $10,000 for at least a full year? Is the I-bond fixed rate component above 0.5% right now? And do you have a business entity to double your purchase limits? Answering these questions builds out your strategy. Now, managing all these layers can get a little tricky, so utilizing tools like Bean Count's plain text accounting can really help keep your general ledger synced across all these different financial lockups. I want to leave you with this final provocative thought. How will you reallocate your cash reserves today? Stop settling for that 0.01% at the big banks. You now have the knowledge and the exact blueprint to strategically structure your savings using the layers we just explained. Take control of your cash, build out your layer cake, and let your money do the hard work for you. Thank you so much for hanging out with me in this explainer, and happy saving.